It's Monday, September 15th, 2008. A 158-year-old Wall Street bank opens for business, and by the end of the day, it's gone. Lehman Brothers, older than the light bulb, older than the telephone, files for bankruptcy like a failed pizza shop. Phones ring, traders stare at screens, people carry boxes out of a building that used to feel untouchable. Then the shock spreads. Not as a headline, as a silence. Because when a bank like that collapses, it's not just Wall Street drama, it's the plumbing of the economy cracking. And when the plumbing breaks, everything above it floods. Before we get into how this happened, I want to know something. If you were old enough to remember 2008, where were you when it started to feel real? Put it in the comments, one sentence. I read them. Now here's why this matters right now. The 2008 crisis wasn't an asteroid, it was engineering. It was a system designed to look safe right up until it wasn't. And the same incentives that built it never truly left. So let's walk through it like a story, not a textbook. Because it didn't feel like a textbook, it felt like a trapdoor. After the dot-com crash in 2000, a lot of people felt burned. Then 9/11 hits in 2001, and confidence drops again. Businesses pull back, consumers pull back, the economy starts moving like it's walking through mud. The Federal Reserve responds with the bluntest tool it has, interest rates. They cut and cut and cut, eventually pushing rates down near historic lows. Translation, borrowing money gets cheap, really cheap. That sounds like a win, and at first, it is. Cheap money makes it easier to buy cars, start businesses, and refinance debt. But it also does something else, something quieter. It makes assets inflate. Because when money is cheap, people don't ask, is this worth it? They ask, can I afford the monthly payment? And that small shift is how bubbles are born. In the early 2000s, housing becomes the national obsession. Not home ownership, the wholesome version, housing. A house stops being a place you live, it becomes a story you tell yourself. This is how you get rich without being rich. People at barbecues stop talking about sports, they talk about equity. A friend buys a house, it goes up, and suddenly everyone feels stupid for not buying one yesterday. And banks notice. They notice there's endless demand for mortgages, so they start producing them the way fast food chains produce burgers. More volume, less care, move the line. Traditionally, getting a mortgage meant proving you could actually repay it. Income, job history, assets, a down payment, the boring stuff. Then comes the innovation, subprime mortgages. Loans to borrowers with weaker credit, less stable income, or too much debt. In a healthy system, that would mean higher scrutiny. In 2005 America, it meant paperwork got flexible. And this is where the story turns from boom to absurd. Ninja loans. No income, no job, no assets. Read that again. A bank hands you a mortgage and basically says, we're not going to check if you can pay. We're going to assume the house will take care of it. That is not lending, that is hoping with paperwork. And if you're thinking, why would a bank do that? Great question. Hold it. That's the whole plot. Because by this point, houses aren't being bought to live in, they're being bought to flip. People purchase a home, watch the price rise, sell it months later, repeat. Some buyers own 2, 3, 5 houses, often with tiny down payments, sometimes with none. The house becomes a lottery ticket you can refinance. And when everyone believes prices only go up, even bad loans look good. Because the backup plan is simple. If you can't pay, you sell. The problem is that backup plan only works while prices rise. Now here's where Wall Street enters and turns a housing mania into a global financial crisis. Banks originate mortgages, but they don't want to hold them for 30 years and slowly earn interest. That's too slow. So they bundle thousands of mortgages together into a product called a mortgage-backed security, an MBS. Think of it like this. You take 1,000 IOUs, toss them into a blender, pour the smoothie into a fancy bottle, and sell it to investors. Pension funds buy it, insurance companies buy it, banks buy it, investors around the world buy it, because it's pitched as safe, Americans will always pay their mortgages, and even if they don't, houses always go up. Two beliefs, both wrong, but very profitable while they last. If you're enjoying this breakdown and want more finance stories explained like a thriller instead of a lecture, subscribe. We do this every week. Calm voice, sharp details, no fairy tales. Now here's the next piece, which is crucial. Ratings agencies, Moody's, S&P, Fitch. Their job is to rate investments, basically to tell the world how risky something is. AAA is as safe as it gets. Junk is junk. Here's the conflict. The banks creating these mortgage securities paid the ratings agencies to rate them. So the person asking, "Is my product safe?" is also the person writing the check. That's like paying a food critic to review your restaurant and acting surprised when you get 5 stars. So what happens? A pile of risky subprime mortgages gets labeled AAA. Not all of it, but enough of it, enough to make huge institutions comfortable buying it. And then Wall Street says, "Nice, but we can do more." Enter the CDO, collateralized debt obligation. It sounds like something designed by a committee that hates humanity, but the idea is simple. Take slices from many mortgage bundles, some good, some terrible, and stack them together and sell the stack as a new product. It's financial lasagna. And Wall Street claims that by mixing risk, you reduce risk. This is the part they treated like financial alchemy, turning garbage into gold. Only it wasn't alchemy, it was optics. Because the underlying loans, the actual mortgages, didn't magically improve. A borrower with no income didn't become safer because their loan got renamed and reshuffled. So here's a question for you. Should ratings agencies be paid by the investors who rely on the ratings instead of the banks issuing the products? Tell me what you think in the comments, because this one change alone could rewrite the incentives. Now, while this machine is humming, a few people notice something. They look past the packaging. They look at the loans inside the blender, and they realize these mortgages are going to fail. Not someday, soon. So they start shorting the housing market. But how do you bet against mortgages? Wall Street gives them a tool, credit default swaps, CDS. In plain English, a CDS is like insurance on a bond. If the bond fails, you get paid. Except here's the twist. You didn't have to own the bond to buy the insurance. So you could buy insurance on your neighbor's house and profit if it burns down. And not just one policy, 10 policies, 100. Now scale that up across the financial system. The same mortgage bond could have multiple CDS contracts stacked on top of it, multiplying the damage if it failed. This is where fragility becomes the main character. Banks and funds are massively leveraged, meaning they borrow money to amplify returns. Leverage is great on the way up. It's a rocket booster. On the way down, it's an anvil. Regulators are supposed to slow this down, but the mood of the time is markets are smart, innovation is good, and everyone is making money. Ethics becomes a rounding error. And then in 2006 and 2007, the unthinkable happens. Home prices stop rising. Then they fall. Suddenly, the backup plan disappears. People who took adjustable rate mortgages see their monthly payments reset higher. They can't refinance because their home isn't worth more anymore. They can't sell because buyers vanish. They default. Defaults surge. Foreclosures spread through neighborhoods like a stain. And now every safe mortgage security is exposed because its value depended on mortgages being paid. Investors ask the obvious question, what are these things worth? And nobody can answer. Because the products are complex, opaque, and tangled together. Everyone suspects everyone else is holding toxic assets. So, trust collapses. Banks stop lending to each other. Credit markets freeze. This is the moment the crisis stops being a housing problem and becomes an everything problem. Then comes Lehman. Lehman Brothers was loaded with bad mortgages, massive leverage, and pure confidence. Earlier in 2008, Bear Stearns had been rescued in a rushed deal, so everyone assumed there was a safety net. But in September, Lehman isn't saved. It collapses. And that single failure sends a shockwave. If Lehman can fall, nobody is safe. Panic spreads fast. Money market funds, things people treated like cash, start breaking.
big banks wobble. AIG, one of the world's largest insurers, is suddenly on the brink because it sold huge amounts of CDS insurance without the money to back it up. This is when the crisis goes global. European banks are tied to US mortgages. Asian economies slow as trade freezes. Investors yank money from smaller countries and rush to safety. It's no longer America's problem, it's everyone's. The US government steps in. TARP launches, a $700 billion bailout. Banks get capital. AIG is rescued. Auto companies are saved. And a new phrase enters everyday language: too big to fail. Meaning if a giant collapses, it can drag the whole economy down with it. The Federal Reserve cuts rates to near zero and starts quantitative easing, creating money to buy assets and keep markets from freezing. It works.
The system survives. But here's the split screen. Wall Street heals, bonuses return, stocks recover. Main Street doesn't. Millions lose jobs, homes are foreclosed, retirement savings vanish. For many people, recovery just means paying rent. Anger follows. Occupy Wall Street rises with one idea: we are the 99%. And what hurts most is accountability, almost none at the top. So the real lesson of 2008 isn't just greed or bad housing loans. It's this: when profits are private and losses are public, risky behavior makes sense for those in power. The final question is uncomfortable. Did we fix the system or just patch it and keep the same pressure inside? Think about it.